Most people think building wealth requires dozens of investments: crypto, options, real estate flips, trending stocks. But in 2026, complexity is the trap. The truth? You don't need 20 assets. You need the right three. Three investments that are simple, scalable, and built for long-term growth. If I had to build wealth from scratch in 2026, this is exactly where I would start. No hype. No gambling. Just a clear, focused plan. The first investment I would start with in 2026 is broad market index funds. Not individual stocks. Not complicated strategies. Just low-cost diversified index funds that track the overall economy. In the United States, that could mean an S&P 500 index fund. In the UK or Europe, it could mean a global or developed market ETF that spreads exposure across multiple countries. The reason is simple. Broad market funds reduce risk by owning hundreds or even thousands of companies at once. Instead of betting on one winner, you participate in overall economic growth. Historically, markets recover from downturns and continue expanding over long periods of time. By investing consistently every month and holding long-term, compounding works quietly in your favor. Fees are low, management is passive, and performance closely follows the broader economy. This makes index funds a strong foundation for anyone who wants steady, disciplined wealth building without constant decision-making. In 2026, simplicity is an advantage, and broad market ownership is the most reliable place to begin. The second investment I would focus on in 2026 is high-quality dividend-paying assets or income-generating ETFs. While growth builds wealth over time, income creates stability and psychological strength. Dividend stocks or dividend-focused ETFs pay regular cash distributions, which can be reinvested to accelerate compounding. In uncertain economic periods, companies with strong balance sheets and consistent cash flow tend to remain resilient. These are usually established businesses in sectors like consumer goods, utilities, healthcare, or energy. The goal is not chasing the highest dividend yield, but focusing on sustainable payouts backed by real earnings. For UK, USA, and European investors, diversified dividend ETFs provide exposure without depending on a single company. This creates a balance between growth and income. When markets become volatile, dividend income continues flowing, which reduces emotional panic and strengthens long-term discipline. In 2026, building wealth is not just about rapid appreciation, it is about creating steady cash flow that supports reinvestment and long-term financial confidence. The third investment I would include in 2026 is real assets, particularly real estate exposure through REITs or diversified property funds. You do not need to buy physical property to benefit from real estate growth. Real estate investment trusts allow investors in the USA, UK, and Europe to gain exposure to commercial buildings, logistics centers, residential developments, and data storage facilities without large upfront capital. Real assets provide protection against inflation because rents and property values often adjust over time. In a world where currency purchasing power can decline, owning income-generating property assets adds resilience to a portfolio. REITs also typically distribute regular income, which supports reinvestment and steady growth. The advantage of real estate exposure is diversification beyond traditional stocks and bonds. While markets fluctuate, property demand for housing, logistics, and digital infrastructure remains structural. In 2026, combining index funds, dividend income, and real asset exposure creates a simple but powerful foundation. Each component serves a different purpose: growth, cash flow, and inflation protection. That balance is what turns investing from speculation into strategy. Now here is what makes this three-asset strategy powerful in 2026. It is not about predicting which market will explode next. It is about combining growth, income, and protection in one simple structure. Broad market index funds give you long-term economic participation. Dividend-focused assets provide steady cash flow and psychological stability. Real estate exposure adds inflation protection and diversification. Together, these three create balance. Many investors lose money because they constantly change strategies. They jump from trend to trend, reacting to headlines instead of following a plan. But wealth is built through consistency. If you invest regularly, rebalance once or twice a year, and reinvest income, compounding begins to accelerate quietly. The key is automation. Set monthly contributions. Avoid emotional decision-making. Think in decades, not weeks. In 2026, markets will still experience volatility, political shifts, and economic uncertainty. But disciplined investors who follow a structured allocation model are less likely to panic and more likely to benefit from long-term growth. Simplicity is not weakness. Simplicity is control. And control is what turns ordinary investing into real wealth building. If you truly want to build real wealth in 2026, you do not need complexity, you need discipline. 3 core investments are enough if you stay consistent. A broad market index fund to capture long-term economic growth. Dividend-focused assets to generate steady income and reinforce patience. Real estate exposure to protect against inflation and add diversification. That combination covers expansion, cash flow, and resilience. The biggest mistake investors make is searching for the perfect asset instead of building a repeatable system. Markets will change. Headlines will create noise. New trends will appear every year. But a balanced strategy built on diversification and automation can survive uncertainty. Invest monthly, reinvest earnings, review your allocation once or twice a year, and ignore daily market drama. Wealth is rarely built through excitement. It is built through repetition. In 2026, clarity is your greatest advantage. If you focus on simple, proven structures instead of chasing hype, you position yourself for long-term financial freedom. And that is how ordinary investors quietly build extraordinary results.